What is up, YouTube? Welcome back to Stocks by the Numbers. Shout out to Specs Bundy, who wanted us to take a look at AcuityAds Holdings, ticker symbol ILLM, listed here on the NASDAQ. Stock right now closed $1.40 a share, down 2 cents, just about 1.5% here on the day. The company recently bouncing off lows here of about $1.38. As we see, this is basically an all chart that I just kind of compressed into the screen here, and you can see that looking at the all chart, we have the bottom fib here of $1.38, so understandable as to why it bounced off that low, and that's actually right around the price of the book value per share for this company. But wanted to do a quick overall analysis, so let's get into it here. Let's check some numbers here. Again, 52-week range, low is $1.38, high is $3.08. This company's in the digital ads sector, and basically revenue has kind of, I don't want to say stagnated or plateaued, but it's just a little volatile. It's bouncing around, like it's up and it's down, but overall not too bad of a company here. We have a market cap of a touch below 80 million. We come down here, we can see the company missed on 2 of the last 4 quarters for the EPS side. We have Q1 of 23 coming in here, estimates of -3 cents. Earnings are coming up soon. Last year, this time, the company came in with a big miss on the EPS side. So that's why, as of right now, again, this is another situation where this is a small cap company that, as we see here, was at lows, got really pumped up here, in my opinion, from the stimulus money, again, like a lot of these other stocks, and has just been slowly falling back down, coming back down to earth where it was before these big pumps happened. And, now it's more fair valued, and we can see where it may move moving forward here from this grounded level. But if we come down here and we look at the revenue, as we can see, Q4 looks to be the best quarter for this company. Back in 2021, bringing in 29.1 million and profit margin of about 6.7%. Next quarter, revenue dropped by about 10 million. The company was extremely negative for the quarter, but they did bounce back, net income positive after that, jumping up to about 22 million. Here we got 20.9 million. And then, of course, Q4 comes in again, their big quarter, 29.46, year before 29.1. So at times the company is growing, but as we see here over the years, going from about 51 million back in 2018, up to north of 90, and then just a little above 80, and then back up to north of 90, and now slightly below 90 for the year of 22. So 23, that's why expectations are a little bit higher, and they're expecting the company to get back into the 90 million mark. But again, they do have some debt on their balance sheet, but bringing in, about 80, 90 million for the year, and the stock right now has a market cap of about 80 million. So I guess you can say it's kind of in line, and that's why I kind of drew both of these arrows here, because again, we do have earnings coming up. We'll look at that in a second, and depending on how this company posts this quarter here, because again, Q1 this time last year was a big miss on the top and bottom line, so we have to see how this company is looking. But these are my long-term trend lines here, as we see in the orange. That's basically the overall top trend line and the overall bottom trend line. See how I just drew it against these bottom candles here? And as we can see, this is like our widening megaphone, because the company had such an explosion after the stimulus checks came in. So now we have this widening trumpet where really doesn't really tell us definitively where this stock could go. However, going from the lows, as we see, this was right here, pandemic, March 2020, and then, of course, everyone took the stock from 50 cents to $26, which is pretty extreme. I mean, this company, again, I know in this time frame there were a couple of decent quarters that they came in with. However, up here at this price, you're looking at a market cap of like 1.5 billion for this stock. So, if you were in and you jumped in and you rode this wave, hey, listen, congratulations. I'm glad you made a lot of money. It shouldn't have gone up that high, and obviously from 50 cents to $26. I mean, that's just ridiculous. But again, if you were in that, obviously you were very happy to see it. And then if you were smart enough to catch the fall and see that it was going to correct itself back to basically where it was before the pump, then obviously congratulations if you jumped in on the short side. But as of right now, we can see, just zooming in a little bit. Well, actually, I zoomed in and then I backed out, didn't I? So I just want to show you guys, okay, so now again, this is from the lows of COVID, basically, pandemic, to the highs. And you can see now we're directly in this symmetrical triangle here. Now, obviously, in the shorter term, again, I drew out these trend lines, and now we're in this trumpet pattern again, which unfortunately is kind of undetermined. Again, we have our up arrow and our down arrow right here with the stock meeting both of these trend lines with earnings coming out soon. So this is moving into what this apex is like June of 2024. So this stock can easily, come in with a decent quarter, bounce off this trend line, get back up to like the twos where it's been trading for like the last 8 or 9 months, and just continue to like bounce around and ride this bottom trend line, get to this apex here at about 2.5. And again, we're talking obviously 12 months into the future. However, even if the company comes in with some healthy numbers, they really shouldn't break it too much higher out of these trend lines. So even if it gets up to about 3 and change, it really should technically stay in this pattern unless something big happens, and then we'll have to reevaluate the company and see how the revenue was coming in over this 8 or 9 months and see where it could potentially go moving forward, whether it breaks down or breaks up out of the symmetrical triangle. But more importantly, in the short term, it is this trumpet, and of course where the stock has been trading as of late, right? So this is going back to September of last year. Right, so that's what, like the last 8 months. And as you see, the stock's like 207, 208, 205, right? And it bounces down and it pulls down to what? $1.38, makes the new low, bounces back up to about 2, drops down to 140, bounces up to about 2, drops down to 140, right? So this is our range. It just recently broke this range actually and started to pull back towards the bottom of that $1.40 to $2 range, right? And that's why I'm saying, because now everything is diverging here on this point here where our apex is. And now we have earnings coming out exactly 1 week from today, May 11th, next Thursday. Estimates of 3 cents a loss per share and only $18.85 million in revenue. And again, I wanted to back that up to here. So this is Q1, as we see, period ending March of 22. They're about to report March of 2023. And here we look, 1 year ago this time, the company had a very big miss on the profitability side and missed by almost $1 million on the revenue side. So they came in just a touch over 19 million. Streets were estimating almost 20 million on the dot for them. So over a 4.5% miss on the revenue side. So that's why estimates are down here again, because not only do they feel that this company is continuing to struggle, but of course you look back, you look at the history of the company, and again, like I just mentioned, this time last year the company struggled, so estimates are down. And also, more importantly, the estimate here is 18.85 million, right? And if we look 1 year ago, they came in with 1903. Estimates, again, were higher, but they came in with 1903. Now, 1 year later, the estimates of Wall Street are now like 150 million lower than it was this time last year. So this is why I'm saying that this is a very tricky situation, because you could say the company could have a pop. However, at the same time, you could say that the stock is also undervalued, because estimates on the EPS side and the revenue side alike are now slipping and going lower and lower, right? So I'm bringing this up because just to lay out what could potentially be the worst case scenario for you guys if you're long on the stock. If these estimates down here at 18.85, if these are our estimates and the company comes in lower than this, I have a feeling they're going to destroy the stock. And that's why I drew out these long-term bottom trend lines here. And again, this is a massive drop here. We're talking what, like almost a 60% pullback, going from $1.40 to sub 70 cents, right? So over 50% pullback. However, it may be justified, because even if we check some of the numbers here, some of the numbers do look rocky. However, on the positive side, if the company does come in with, let's just say like 19.5, 20 million, and, everything's fine, then chances are they will break it out of these trend lines, and at minimum, you will get back to this like 205, 207 mark that I drew out here, that as we see right here, and here, and here, you have a lot of bounces, even going back to here, that's where it broke up above that trend line and then broke out and took that next leg higher. There was the gap down there after this company started trading a couple of months later, and that's where it gapped down and opened right at this mark here of the low twos. So that's, in my opinion, is where it's going to go. Obviously, I'm on the 1 year right now, and you can see these fibs here like $1.58, $1.61, $1.66. Obviously, it will, bounce and slowly break through those numbers. But if the company comes in with good earnings, you're going to see the low $2 again. But even if they wrote it up here to like the mid-range in the short term in the next couple of weeks and brought it up here to the low threes, in my opinion, if you got in recently, if your cost is like $2 or like $1.70, $1.60, in my opinion, if I stepped in here at $1.40, they come out with a good quarter, and within a couple of weeks they run it back up to $3. In my eyes, I would sell that. That is a phenomenal return. And remember, this was a stock that started out before the pump down at 50, 60 cents. So at any time they could technically crash it down. The market cap's only about 80 million. So, it's these small micro cap stocks that are the most volatile ones. So you could have an interesting play here. But again, I just want everyone to understand the risks involved. Just because it was up here, it doesn't mean you're buying a $25 stock for $1.40. Everything trades where it trades for a reason for the most part, despite NVIDIA that we just looked at that I got completely wrong. That doesn't trade where it's supposed to trade. But, we always have our anomalies. Our Teslas, right? Tesla, tremendously overvalued for basically since it went public and started making money. But that's fine. But, again, I wanted to show you guys here this little point, these diversions. And again, it's really going to come back to the earnings. And I know it does suck that sometimes it does rely on earnings because we just want to catch a rise, or, if there's a pattern setting up, we want to catch a break or break out and make some quick money. Totally understand that. Your best case scenario here, if you didn't want to play earnings, you could step in here, in my opinion, and catch it bouncing off this trend line and potentially make a couple of bucks here, and have it rise up to like $1.50, maybe $1.56 here, $1.61, that fib level, and have them bring it up for you going into earnings. That's probably your best bet if you're looking for a quick flip. And again, the company's earnings reports are kind of sporadic and volatile. So, me personally here, if I had some cash on hand, this wouldn't be something that I would go into with high conviction. So in my opinion, if you're doing an earnings play here on AcuityAds, you're completely rolling the dice. Because again, the technicals, the only real technical that helps you out here is the fact that if they beat, it could bounce up to $2. And of course, if they come in negative, as I said, they can really beat the crap out of this, and you may see it sub $1. But looking at some of the numbers here, just to dive in quickly, we can see the company is losing money per share, so there is no PE. They're trading less than 1x sales. They have been lower. They have been significantly higher, trading 61.7 times cash flow, random motorcycle going by, trading only 1 times book. As I mentioned, book value is about $1.30 and change. And look here at this enterprise value again. That is supposedly what another company would pay to buy out this company. And as we see here, the enterprise value has been significantly higher. But overall, the median average here, we're looking at around like 40, 45, 50 million even over these years. And now the enterprise value is sitting here at 5.4 million. So that's why when you look at some of these metrics like this is one of the situations where it can go either way. And again, I personally don't have very high conviction on which direction until those earnings come out. And it's very simple. If the earnings are trash, then the company will crater down. If they come in with a nice beat and a nice surprise and show that, they're back on track and, everything's going to be fine and they're going to start growing from here, then obviously the stock is going to get rewarded. You're going to see 2 in the short term and could potentially even double your money into the 3s. But, it's really all up to the company here. Return on assets went negative. Obviously, they were, in the decent single digits, pulled back now to minus 0.5%. Return on equity, a little under minus 1%, was up in the double digits. Same thing with return on invested capital. We look at the gross margin here, it's down at 45%, has really been just sliding a little bit for the last couple of years. However, even here at 45, we can see minus this 2016, has overall been, I guess, above the average. So I guess if we did the mean average of all these numbers, it'd be around 45%. So that really isn't too much of a red flag. Good to see that the operating margin went back positive, as we see here, was climbing here into the into the high single digits, pulled back here, minus 4.5%, now sitting plus 1.5%. So that's a good sign. The EBITDA, of course, earnings before interest, taxes, depreciation, amortization, as we see, was very low here, single digits, going negative, slowly begins to climb year over year. Good chunks up here to the 15, 13% marks, and then, of course, pulls back slightly negative, but has since bounced. Now it's up at almost 5%. So that is actually a pretty good sign. And also the net margin percentage we looked at before, as we see here, a company negative for years and then pulls up into positivity, has a rough pullback year here, and is now basically flat but slightly positive. So, you know, there are some positive metrics, there are some negative metrics. That's why if people in the comments, you know, if you guys come out and say, oh, I think it's a buy, I think it's going, you know, back up to 250. Yeah, understandable, I can see it. Or if someone else comes out and says, you know, I don't know, they're kind of crappy, you know, they're unpredictable, the business seems like it may have plateaued, the revenue is kind of stagnated, I think they're going to pull it back to $1. Yeah, I can kind of see that too. So that's why, you know, in my opinion, I really don't have a very definitive direction here. The asset turnover, this is interesting, right? Because it tells you it can be used to measure the effectiveness in which a company uses its assets to generate income. The higher it is, the more efficient the company is, right? Supposedly. So if we look here, the asset turnover is down basically over 50% from where it was several years ago. And now you had consistent drops really 3 years in a row, and then you had a nice jump back up to about 1.7, and then obviously 1.4, and now we're down in the 0.8s. So again, you know, I don't know if I would use any one of these metrics, you know, to be overweighted compared to other metrics. Because again, overall, it just kind of looks unpredictable. We look at the cash here. What am I looking at? Assets sitting here at about 100 million. You know, we have good growth here for the last couple of years on the asset side. Obviously, it's the first time it pulled back in asset value. It's going back to 2016. However, still maintaining that $100 million mark. Liabilities have basically been steadily decreasing since 2018. So this is what I'm saying. As much as they want to bash the company, they do have some positives going on here. About 55 million in net debt. Now this is interesting, right? Because I don't know if we ever broke these down, but look at this here. The total debt, right? We have total debt, we have net debt. The total debt represents all interest-bearing obligations of the company, regardless of when these obligations are due for payment, right? Total debt can be shown as long-term debt and short-term debt. Okay, so those are interest-bearing obligations. But look at the net debt. Net debt represents the amount of debt that would remain after a company had paid off as much debt as possible with its liquid assets. This financial metric shows how well a company can handle its current obligations and if it has the ability to take on more debt in the future. Now, debt has been going down. However, this net debt, again, as we see here, has really jumped up here in 2021, and even though it has pulled back, it's still sitting here at minus 55 million. So this is why a lot of people are looking at the company, right? You have sporadic, spotty revenue. You're kind of like in line, but as you see here, you know, you're holding a lot of debt. So as of right now, what? I think the market cap is what, like 75 million or something? 79 million, right? So, you know, some Joe Schmo analyst could just be sitting there saying, oh, well, the market cap's 79 million, but you got like 55 million in debt. You know, your revenue isn't growing. So, you know, if we subtract those, that's like 24 million. And, you know, that may be where that low enterprise value that we looked at last time is really coming from. However, again, I have to say this may, regardless of the negativities, this may be near the bottom. Again, we have that daily fib, and on the 5-day and the 1 month, I believe the bottom fib is like $1.38, and that's where the low was. So it bounced off that fib. We have the book value per share right here at $1.34. So right here in the immediate future, this next couple of days going into earnings, that may be the lowest it goes. However, again, that is not necessarily the major benchmark support for the stock. So again, I just want you guys to understand the risks involved. But again, over the years, as we see, even though revenue is kind of stagnated, you know, they are more and more profitable over the years, going from minus 16% back in 2018, minus 4.7% on the profitability side. And then look, 2020, they go positive, 3.5%, over 9.5%, and then they had a rough 2020. So this, in my opinion, would have been the breakout year, right? So they came in, yeah, 80, 90 million, 96 million. So if this company came in this year, 2020, with like $102 million, and the profit margin was like jumped into double digits, was north of 10%, right? They would have had that continued growth on this trend line here for the profitability side, and that would have been pumping the stock up. Right now it would be at, at least like 240 or 270 as opposed to $1.40. But again, as much as we may like the stock or talk about the stock, it really does depend on earnings. And if we look here again, just, kind of sporadic, coming in with bigger losses than expected and then breaking out with more profitability. So then they pump up estimates, but then they miss. And, estimates are supposed to be growing, but then they miss again. And, then they come in line here and pull back negative. And as you see here for 2023, they're expecting a loss of 8 cents per share for the stock, and not even showing them getting back to flat till 25 and profitable till 26. So that's why this is something that may take a lot of time. And when I drew out that symmetrical triangle in the beginning of the video, going all the way out to June of 2024, I believe it was, that, now you can see as to why it may need a lot of time to really start rocking and rolling. See, revenue doesn't even surpass 100 million on estimates until 2025 and 2026. So this company, if you tell me right now this company is going to remain flat for the next 12 months, would be understandable. However, as we see, overall coming in above estimates again for the years, profitability side was struggling, missing on 4 of the last 6 years on estimates. So, really only time will tell. As we see here, look, even when they break down the sectors, right, the managed services, up to 67, down to 63, and then up to 72, but then down to sub 60. So it's just bouncing around. The self-service sector has been performing very well here, seeing some nice jumps here. I know they had a massive jump here from 18 to 19, and then a slight pullback. But of course, remember, this was pandemic, and then the year after, they're basically back at where they were before everything got shut down, and now they surpassed it up to 29.5 million. So the self-service sector is supplementing the loss in the managed service sector. But again, as we see, 80 to 90 million, this company has basically been staying in that range for total revenue for the last couple of years, and they really need to break out. We're seeing a little bit of growth here in Canada. This is probably the best performing sector here as well. Now it's higher than where it was in 2019. I mean, so is Canada. However, you see in 2021 it was, even higher than where it is now. So I don't know if I'd use that as a metric. However, good growth here over in Europe, Middle East, Africa. So basically it seems like the company just has to pick its spots. It has to increase, its clientele, get some names in that Rolodex. And, moving forward, I'd say they were on a pretty good trajectory as we saw here, minus this rough year of 22. So they may need some time to get their ducks in a row. Overall, it could pay off for you. But again, right now, here in the short term, going into these earnings, a little bit of an unclear picture. And me personally, I don't know if I would take a position here. However, again, if anyone is going long, going short, betting forward, betting against, I wish all of you the best of luck. Not all of us will be correct and make money, but again, if you're involved, I really do wish you well here with the stock. And we can move over here to stock charts real quick also before I let you guys go. As we see here, RSI has been pulling back and selling off now. It's sub 34. That's why I'm saying it may be ready to have a little bit of a rally here now in the next couple of days going into these earnings reports, right? Because they've been beating it up for a little while. MACD's been sliding down here, as you see, slightly went negative right there. So we could have a curl. We could have a little bit of a pop here again, as I said, back to like 150, 155. And as we see, the 50-day moving average here is 156. So 182, this 200-day on the daily, that will be hit, in my opinion, after they beat earnings, if they do beat earnings. Hoping they do, obviously, for all of you who are holding it. But again, here, look at this. Just look at how flat this MACD is. Look at how tight these Bollinger Bands are now in this range. That's why, again, this company does have a lot of negative metrics. However, here on the technical side, it does look like we may have a little bit of a short-term explosion here. They may very well bring this up to the high ones and run this sumbitch into earnings. It really is possible. It really is possible. Again, the RSI, my apologies, RSI in the weekly was about 37. We'll go back to about 37.5. So near the lower end of the range. Obviously, the RSI has been significantly lower. However, hasn't really broken above this 50 mark for quite some time. See, this is what I'm saying. This is a very, very interesting play. The problem is it's kind of with a rough, unpredictable, sporadic reporting company. Because if this was another stock lining up like this, a bigger brand name of a company with more consistency over the last couple of quarters and the last couple of years, I would probably tell you to take a sizable position here and catch this explosion, going into this earnings report, basically just knowing that you're going to make money. And that's why this is a rough call to make here, because, again, on the technical side, you could say it could have a pop here. However, again, the company is struggling in a couple of metrics. So having them come in light on these earnings and break this trend line and start dropping into the low ones, that is very possible as well. But again, for the record, I'm sure more than half of you are, bullish on the stock, not bearish. So this company coming out with earnings next week, again, I really do wish you guys the best of luck. And I'm going to leave it there because I'm just babbling. So once again, this is Stocks by the Numbers. I want to thank you guys for stopping by. If you have any questions, comments, or concerns, drop them down in the comments section. I'm usually very quick to reply. Just like everyone on YouTube says, like the video, thumbs up, algorithm helps me out. Subscribe to the channel, means a lot to me. Moving forward, I understand that markets are rocky and they're volatile and they're uncertain. I wish everyone success. I hope everyone makes a couple of dollars. Stay sharp, stay positive, stay focused, stay disciplined. And thanks for stopping by. I'll catch you in the next one.